Oil market may be heading towards major turning point because there are growing reports that the International Energy Agency could coordinate a large release of strategic oil reserves. If that happens, it could push oil price lower very quickly. And when oil price moves suddenly, the impact doesn't stop in energy markets. It spreads across the entire global economy, inflation, interest rates, and even stock markets. But what is really interesting is that this situation is not new because history has seen similar moments before. And when we look at what happened during those times, we start to understand what investors might expect next. First, why oil price moves so fast? Let's look at a map of the oil supply in the world. We can actually see that the Strait of Hormuz covers almost 21 million of barrels per day. Secondly, the Strait of Malacca comes first with 23.2 million of barrels per day. When we also look at oil production per country, in 2024, the United States came first, Saudi Arabia second with 10 million of barrels per day. So oil is one of the most sensitive commodities in the world. Small change in supply or demand can move price dramatically. That's because oil sits at the center of global economy. Transportation, manufacturing, energy production, and logistics all depend on it. So when markets fear that oil supply could be disrupted, for example during the geopolitical tension, price tend to spike quickly. But government also have tools to calm markets. One of the most powerful tools is releasing oil from strategic reserves. Because oil shock lift that IEA price outlook as Osmo crisis reshape forecast. And the why emerging oil release won't fix this crisis. These are all headlines of today. But government also, like I said, have tools to calm the market. These reserves are emergency stockpile designed to stabilize market during crisis. When large quantities of oil suddenly enter the market, the price often fall, like we saw here. And that is exactly why investors are watching this price potentially and move so closely. In fact, we actually saw this same movement long ago. I'm talking about 2022 during the Russia-Ukraine war. Price skyrocketed and got stabilized again by the same situation we are seeing today by releasing a lot of oil in the market. Government were worried that the rising energy costs would push inflation even higher. So major economies coordinate a massive release from strategic reserves. Millions of barrels of oil entered the market over several months. The goal was simple: increase supply and cool prices. And it worked because oil price gradually stabilized and additional supply reached the market. We also hear a slow consolidation during those moments. This example shows something very important. Energy markets can move quickly when government intervenes, but the reaction is rarely permanent. Oil price eventually return to be driven by supply, demand, and long-term economic conditions. Another historical parallel happened in the early 90s. I'm talking here about the Gulf War. At the time, market feared a major disruption in the Middle Eastern oil supply. As you can see here, the price skyrocketed at that time and then also got stabilized, touching the 200 moving average and consolidation during those moments, almost 10 years of that moment. Investors were worried about long-term shortage, but once the situation stabilized and supply fear eased, price fell again. The pattern was clear. Market reacted strongly to fear in the short term, but once the worst-case scenario failed to materialize, price adjusted quickly. This pattern has repeated many times throughout modern financial history. Markets often move first on fear and then later adjust to reality. Today we have this kind of situation, the beginning. When you look at the weekly time frame, we are actually in that moment. The price skyrockets, and then Donald Trump said the war might end soon, and the oil price crash. Based on this, we can just assume that by releasing oil in the market, the price will tend to navigate around this era before continuing a big consolidation for a long period of time. Based on that, we can actually check what happened on the S&P 500. The price got rejected directly by touching the 200 moving average. This is institutional decision, not actually synchronized with Donald Trump saying the war might end soon. So we can actually see that based on this, when the S&P 500 move higher, oil price will just jump. Now, we can actually also know that when geopolitical tension rise, traders quickly price in the possibility of supply disruption. But if government step in with additional supply, such as releasing strategic reserves, the market reaction can reverse quickly. Lower oil price can actually bring relief to other parts of the economy. For example, cheaper energy can reduce transportation costs. It can also ease pressure on inflation, and in some cases, it can even support stock markets. This is why oil is often considered one of the most important indicators in global finance. It doesn't just affect energy companies, it also affects everything. But investor psychology behind oil shock is actually very different. Many news are saying that why emergency oil release won't fix this crisis. They said investors rattled by the war in Iran have sent oil price skyrocketing, and global governments have noticed the world's biggest economy are now consider emergency release of millions of barrels of oil into the market. But while that might sound like a lot, experts say even 10 of millions of barrels are more like a drop in the bucket when it comes of global oil needs. Moments like this can feel stressful for investors, of course, because when headlines talk about wars, energy crisis, or supply shocks, market can look chaotic. But history teaches us something very important. Short-term volatility is normal, and markets react emotionally at first, then they gradually return to fundamentals. This doesn't mean risk should be ignored, but it doesn't mean that panic decisions rarely produce the best long-term results. Many experienced investors actually use moments of uncertainty to step back and analyze the bigger picture, because some of the best investment opportunities appear when markets are reacting emotionally. Let me talk about a calm perspective for investors, because when we look at the history of the charts, one lesson becomes very clear. Energy shocks come and go, geopolitical tensions rise and fall, but the global markets continue evolving. All markets have experienced dozens of crises over the past several decades, as you can see here. Yet the global economy has continued to grow, adapt, and innovate. For investors, the key is not predicting every short-term move, of course not. It's understanding the broader force shaping markets over time. Energy supply, technology, economic growth, and policy decisions all play a role. And when we step back and look at the bigger picture, sudden market movement often becomes easier to understand. So my takeaway is this for investors. If the International Energy Agency does move forwards with a large oil reserve release, market could react quickly. Oil price might fall and inflation pressure could ease, and some sectors of the stock market might benefit. But as history shows, these moments are part of a much larger economic cycle. Markets move through periods of fear, adjustment, and recovery. Understanding those cycles is what helps investors make better decisions over time. And if you enjoy breaking down complex market events like this in a simple and calm way, make sure to subscribe to the channel and also like. It really helps. That way we can keep following these global market stories together. Because the more we understand the force moving markets, the better prepared we are for the future. Investors, thank you for watching and have a nice day. Trade safe.